So this is a stock. One of my students bought this stock. He lives in France. Originally, he's from Romania, and he bought this stock. And I meet my students every Saturday morning. So he was describing this trade. So I said to him that I will make a video to explain this trade to my YouTube subscribers. Okay. So I have not personally bought the stock. This is Evercore listed on the New York Stock Exchange. So since he's trading from France, he's trading the New York Stock Exchange stocks. So let us discuss this trade. And by the way, from the first buy point till the top, it is around 15.55% return. Okay. I'm not sure whether he has sold the stock or not. Next Saturday, when I meet him, I will get a chance to ask him what he has done. And he bought the stock not once but twice. Okay, so it's not just 15% return, maybe additional 7-8% more when we combine both the positions. So this trade has been a successful trade for him. The important thing is not the return. The important thing is how was he approaching the trade? Why did this stock come on his radar? And what characteristics he was looking for on the chart before committing money to the stock. So that is the thing which we want to study from videos like this. So that is why I am showing you trades taken by my students. I trained him, I think, back in December 2023. So we have been in touch for a very long time, almost 1 year now. And I discuss with my students on email, on WhatsApp. I meet them every Saturday morning. So we can be in touch, we can discuss stocks. Okay. So let's begin. So the first purchase was done on this day, 17th of September, and the second purchase was done on this day, 11th of October. So let me draw the base for you so that you understand. Now, since this is New York Stock Exchange, I will not go to MarketSmith. We will spend time on trading view only. Okay. So first, let us see before this, before buying on this day, what was he looking at on the chart? And by the way, although he did well on the stock, but there are a couple of mistakes that he has made while executing the trade, which I want to highlight to you so that you don't repeat that mistake. It's good that he ended up making money, but he could have lost money. Okay. So there is a learning also for you in this particular trade. So let's start. So first purchase was on this day. So let me hide this out for you so that we can start our analysis. So this is what he saw. So the base starts from here. So you first draw the base. And what are our three conditions before we take a trade? The first condition is blue, green, red. So the 50-day moving average should be above the 150-day moving average, which is the blue green line. And the 150-day moving average should be above the 200-day moving average. So blue line is the 50-day, 150-day, and the 200-day. And the price should be above the 50-day simple moving average, preferably. Okay. That's a stage 2 uptrending stock. So our rule is blue, green, red, then 10 candles in the base. So this is point 1. So you start counting from this candle 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there are easily more than 10 candles in the base. So blue, green, red, 10 candles. Plus we want minimum 4 points in the base. How do you draw 4 points in the base? So by now, I think you this is pretty much clear to you. Point 1, point 2, point 3, point 4, point 5. How do you define these points? Well, point number 1 is the highest point in the base. Point number 2 is the lowest point in the base after point 1. Point number 3 is the highest point in the base after point 2. Point number 4 is the lowest point in the base after point 3. And point number 5 is the highest point in the base after point 4. So you are going from highest to lowest to highest to lowest to highest. That is how you get your 5 points. Since there is no point number 6, we cannot take point number 5 as our buy point. So our buy point becomes point number 3. So the high of this candle, let me delete this. High of this candle, which is 248.06, that becomes our buy point. So 248.06. The high of this candle is our buying price. Okay. And the closing price is very close to the yellow line. So not much distance. It is very close to the buy point. So repeat this rule after me. Blue, green, red, minimum 10 candles, minimum 4 points. Blue, green, red, minimum 10 candles, minimum 4 points. Blue, green, red, minimum 10 candles, minimum 4 points. Just by heart that rule. This is a non negotiable criteria that I use. If there are 3 points in the base, I will not even look at the stock. If I don't have the blue, green, red combination, I will not even look at the stock. Sometimes you get blue, red, green. Reject that stock. Sometimes instead of minimum 10 candles, you get only 9 candles. Please reject the stock. So the rule is blue, green, red, minimum 10 candles, minimum 4 points in the base. That's it. Non negotiable criteria. Okay. And look what happens the next day. The stock tries to break out. Okay. There is no price confirmation, there is no volume confirmation. So the price touches the yellow line. So my student, he bought the stock and he decided that he will give the stock some time. Okay. He decided that he will give the stock some time. Even if it comes down, he will hold the stock with an 8% stop loss. So the stop loss would be somewhere here. I am not drawing the stop loss because that is not important for this trade because the stock went up. Okay. So I am assuming his initial stop loss was 8% below the yellow line. Okay. So he gave the stock some time. Now, this is where he made the mistake. If I was trading the stock, I am looking for price confirmation. I am looking for volume confirmation. If I get one of these confirmations and not the other one, I generally tend to sell 50% of my shares. Okay. Provided the general market is good, I generally tend to sell 50% of my shares because one of the confirmations is not there. If both the confirmations are there, I mean, the volume is above the blue line on closing and the price is above the yellow line here on closing. If both confirmations are there, I don't sell any shares. I keep the stock. So if both confirmations are there, we don't sell anything. If one of the confirmation is not there, we sell half. If both confirmations are not there, we should sell 75% because for one confirmation, you sell 50%. For one non-confirmation, you sell 50%. For another non-confirmation, you sell another 50% of the remaining. So if I have 100 stocks, I don't get price confirmation, I will sell 50 shares. But since I don't have volume confirmation, I will have to sell to 50% of the remaining 50 shares. So 25 shares. So you understand, there are two ways to manage risk. One is by reducing position size, and another is by moving the stop loss. I am not a big fan of moving the stop loss. I am a big fan of adjusting the position size. So if I was trading this stock and if I bought 100 shares at the yellow line, by the end of the day, I would end up selling 75% of all the shares that I have bought. So that would be my approach. Because uh, in my whole philosophy, I am looking for three steps. Step number one is a high volume rally. Step number two is a low volume consolidation in the base. And step number three is a high volume breakout. So step one and step two is already there for me to witness. I am looking for step number three to happen because step number three is the future. Step number three is clearly defined as high volume breakout. Okay. Is this a high volume breakout? First of all, it is not a breakout. Is this high volume? No. So there is neither volume nor is it a breakout. So if I am not getting step three, I am not getting what I am expecting from the market. So for example, if I go to the railway station and I expect the train to arrive at 9:45 and it is 10:30 and the train has still not arrived, okay, it means that the train or the railway authorities did not meet my expectation. So I'm going to look for other modes of transport on that day. Okay. Similarly, I am expecting the stock to break out above the yellow line, close above the yellow line. The volume should be above average. If that is not happening, I am not getting onto this train. Okay. So I am reducing my position size to avoid a further loss. Now, booking, this was a very small loss on 75% of the position. But my student, he did nothing. He just held on to the stock with an 8% stop loss. See, it's not wrong to hold on to the stock. There's nothing wrong, especially if the stock is showing good fundamentals. We will look at fundamentals as well later in the video. But what I'm trying to say is, if you don't get what you expect, you are sitting on huge risk. Okay, you have to be aware that you have taken risk if you choose not to sell any of your shares. Next day, again, no confirmation. Okay, the volume was slightly higher compared to the previous day, but compared to the average, it was still low. Okay, so again, no confirmation of price, no confirmation of volume. At least here, my student should have sold the stock, but he did not do anything. In fact, he looked at the price, is about closing is above the previous day closing, and he held on to the stock. And it's not that he's not aware of risk, he's completely aware of the risk that he's taking. And probably he had some realized gains in his recent trades, which allows him to finance the risk on this particular trade. If his thought process has been like this, then this is a very good strategy to hang in there. As I said, stocks which show fundamental strength, it's worth giving them some time. So if I click here, see, this is Evercore. If I click here, financials, notice 37% growth in quarterly growth in sales. Okay. Net income, 98% quarterly growth in net income. So that's a impressive set of financials. Okay. I'm not looking at margin expansion. I'm not looking at return on equity, just on the basis of sales growth and net income growth. I am saying that this is a company with improving fundamentals. Okay. So that's probably the reason why my student gave the stock some room to fluctuate with an 8% stop loss. The purple line, by the way, is 21-day exponential moving average. And as you can see, the price continues to remain above that 21-day exponential moving average, which is a good sign. If you read Mark Minervini's book, he also recommends that as long as the price remains above the 21-day exponential moving average, the stock is showing strength. When it breaks that purple line, you have to really start reconsidering the stock. So, this is one of the points that he mentions in his book, but it's just one of the points. Okay, there could be other factors which would prompt you to sell even if the stock is above the purple line. So, for example, if you in your recent 4 5 trades, if you have not had any realized gain and you are taking this trade, you would not wait for the price to fall back below the 21-day exponential. You would be quick to cut the position size because you don't want to expand your losses. Okay, you want to limit your losses. Then next, let's see what happens next. See, after this, the stock went up and it had a natural reaction. Natural reaction means low volume decline. So, which means institutions are not selling the stock. It's the retailer who is selling the stock. So, again, it set up a new buy point. So, let me put. Okay, so see, there's another base forming here. So, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. More than 10 candles. Again, blue, green, red, minimum 10 candles, minimum 4 points in the base. So, point 1, point 2, point 3, point 4. So, if you want me to draw this, point 1, point 2, point 3, point 4. Okay. So, 4 points in the base. So, blue, green, red, minimum 10 candles, minimum 4 points, and icing on the cake is the inside bar here. So this is the mother baby candle combination that I look for. The high and low of this red candle is completely inside the high and low of the previous candle. So when that happens, a breakout is highly likely, but we don't know whether it will be upside breakout or downside breakout. Okay. A mother baby candle combination does not mean that the stock will go up. A mother baby candle combination means a breakout is highly likely, but we don't know whether it will be upside breakout or downside breakout. So be clear in your concepts. So point number 3, which is the high of this candle, which is 255.99, that becomes our new buy point. Okay. And as the stock moved up, see, This is a high volume breakout. So here he bought the stock. That is a valid entry. This was not a valid entry, or you should have cut position size here. My student should have cut position size here to limit or control risk. Okay. I think one of the reasons he did not cut position size here is because his original position size itself was small, maybe less than 5%. Okay. That is another reason you could give the stock some time, because you are not holding too many shares. So while buying the stock itself, you are controlling risk. Okay. So what is the need to reduce the position size further? While buying itself, you are going in with a small position size. And then he got another opportunity to buy. So he doubled up on his position. So if you measure, currently the stock is here. I am not sure whether he sold the stock or not. I will ask him in on coming Saturday. But if you measure from original buy point till about this high of this candle, that's 15.55% on this position. Plus currently it is at around 11.32%. Okay. Plus he bought another, he doubled up his position. So from here, again, we count from here till here, that's another 11%. So depending on how you count the return, whether you take this position size or you take a combined position size, you can calculate your return. But from original buy point till the high achieved by the candle, it has gone up 15.55% in a very short period of time, which is a very good trade. So this trade has been very good. The stock was in a stage 2 uptrend. It was forming a base. It was near the 52-week high. It was showing good technical strength, fundamental strength, nice tight base formation, nice buy points, proper buy points, an opportunity to reduce your position size, an opportunity to add to the trade. Everything was there in this trade. And this trade is a very good example of how you should be approaching stocks. This is not some guesswork, or this is not some gambling that my student is doing. He has followed an approach that we have discussed in our coaching sessions over and over and over again. So he is following a systematic process to select stocks. He is following a systematic process to execute the trade, and he is following a systematic process to exit from the trade. Now we'll have to see whether what he's doing at this stage. So that question remains unanswered. I don't know. I'll catch up with him on Saturday and see. But I hope this trade or this strategy is making sense to you. You are waiting till you get a proper buy point. And if you get the follow through, if you get the price action, if you get the volume action, you stay. But if you don't get what you expect, you come out, you reduce your position size. Plus, if the stock gives you another opportunity to enter, you take advantage of that opportunity. Okay. So I hope this video was helpful and it added value to your trading journey. Okay. Please like, comment, and share this video so that this video reaches those people who genuinely want to become professional stock traders just like you. I thank you for your time. I thank you for your support on this YouTube channel. Your time is extremely valuable to me. I do my best to provide you value in each of my videos. Thank you so much.